I think the Fed is manic depressive. I guess that they respond to stimuli from everywhere. At one point in time, they were concerned about raising asset prices, then they became concerned about rising asset prices. At one point in time, they were concerned about too little liquidity. At other times, they're concerned about excess liquidity. When I watch and listen to the Fed, what I really get is dizzy. I understand it's important to understand what it is that they're about to do. And I certainly myself am concerned about the effect of excess liquidity and negative interest rates on capital markets, which is to say, I think that we are seeing speculative excesses really throughout the investment business and probably throughout the broad economy. And it's something to be concerned about it. The fact that the Fed is concerned about it is probably of less interest to me than the fact that they should be interested about it.
You know, when we were talking offline before the intro, I said, Rick, how do you want me to introduce you? You said, I don't care about titles. And that's always been your MO. You don't care about titles. You said, I'm an investor and a speculator, just like all the other regular folks out there. So what is one to do in this environment? How does this play out, I guess, is my first question to you. Like, how much more steam does this market have?
That's better than titles. I like this. Now I can do something useful. First of all, you have to do something that seems counterintuitive and that the Fed doesn't want you to do. You have to hold some cash, Daniela. That's critical. Investors don't want to hold cash because they get a negative real yield on it. They feel like their purchasing power is declining. But if you have a circumstance like this, where the market is frothy as a consequence of liquidity and as a consequence of emotion, rather than because of increases in trade or productivity or other reasons, what you have to understand is that there is some real risk of a black swan event or some tightness in liquidity that gives us the circumstance that we experienced in 2008. I'm not saying that next week the market is going to fall by 50% or anything like that. All I'm trying to say is that you have to maintain larger cash balances than many people feel are prudent. When you have cash, in the event of contraction in liquidity, which causes all prices to fall, you have the tool and hopefully the courage to take advantage of it rather than being taken advantage of by it. I also believe that investors, particularly of my age, over 60, need to maintain some of that purchasing power in precious metals for reasons that we can describe later if we want to. I'm not talking about buying gold because the gold price is going to go up. I'm talking about buying gold because gold traditionally has been insurance against the depreciation of the purchasing power of your savings. I'm also saying, by the way, that you don't need to get completely out of the broad market, or if you have courage, even reduce your exposure to the broad market. Well, I suspect that we will, sometime in the next 2 or 3 years, experience a broad-based decline in liquidity, and hence probably a broad-based decline in equity indexes. I'm also of the opinion that 10 years from now or 15 years from now, that a collection of the greatest companies in the United States, represented by the S&P 500, would be higher than it is today. But while everybody talks about 10 years from now or 15 years from now, everybody lives for the next year and a half or 2 years. So maintain some cash, maintain some precious metals.
Okay, let's take that a little further, the cash part. I get the cash part, but if there's a real crisis, a real black swan, we've seen what happened in the Bahamas when Hurricane Dorian hit and people didn't have access to their cash. They couldn't get to the ATMs. It was the impetus which launched them to launch a digital currency. So how do you get access to that cash in a crisis, Rick?
I suspect that many of your more prudent listeners might store some of that cash in the form of, as an example, junk silver or cash that they had immediate access to. I would encourage your younger listeners, Daniela, who do that, to be very cautious about how they store that cash and how many people that they tell that they have access to that cash to. It exposes you to a whole different set of risks. I'm not discouraging what you suggest. I'm just saying beware of the risks of having a lot of liquid assets in your house. Sometimes people come to visit you whom you normally wouldn't have over for lunch.
But it's not necessarily part of the banking system.
I believe that in the near term, 12 to 18 months, that fears of the collapse of the banking system are overblown. I personally believe that confidence in the system, however misplaced it may be, is very high. And what makes the political system and the banking system work is confidence. So in the very near term, in the 12 to 18 month time frame, I'm sorry, I think that the amount of cash that you have freely available to you doesn't need to represent anything like a year's worth of survival cash. I think the probabilities of a near-term collapse in the banking system are pretty low, despite the fact that among my own crowd, I may be one of the few who believes that.
So basically, do you think that there's a threat though in this general moves? I mentioned Bahamas. We see Japan with the digital currency, China testing out their digital currency, Europe announcing they want to test one out, and we could see one, within the next decade. Does that pose a major threat to commercial banks?
I don't think it does pose a major threat to commercial banks, because I suspect that the commercial banks are powerful enough economic and political entities that they will cause the emergence of digital fiat currencies to serve their own interest. It was famously said that elections are advanced auctions of stolen property, and the outcome can be determined by looking at the interests of the participants. The banks are very large participants, and my suspicion is that any digital currency that emerges from a large fiat will take into account the interests of the banking community. I wouldn't be overly concerned about the fate of the big banks. They seem to be better able to take care of themselves than we are.
I won't lose sleep overnight thinking and worrying about those commercial banks. I couldn't wait to get you on because I want to get your take on this inflation, deflation debate. We've heard the Fed talk of, yes, we will see pockets of transitory inflation, but it won't be runaway inflation. But I've had guests on that saying inflation is through the roof. And I've had guests on saying, no, we are actually in a deflationary period. Where does Rick Rule fit in this equation?
Lots of arguments for both. The overall economy, I think, is deflationary. We have too much debt. And the way that you normally solve a circumstance where you have too much debt is a default cycle. And defaults are very deflationary. If you take a bunch of money that was lent to somebody, saved by somebody else, and that money goes to money heaven, it's deflationary. The policy response to a default cycle, that is the tendency of society and politicians to postpone a default cycle, is inflationary. So you have arguments on both sides. The idea, Daniela, and it's more important to you as a younger person than to me as an older person, that just as an example, the United States federal government has $28 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities, which is to say Medicare, Medicaid, entitlements. That's extremely deflationary. We have built up a debt, which is a bunch of things. It's a transfer of wealth to old fat guys like me who voted themselves a bunch of services from young people like you who wanted to expect those services in the future. We have also built up a debt that is truly unserviceable. It has to be rolled over. That, on the face of it, is extremely deflationary. But you could have a different kind of default, the kind of default we had in the 70s, where you inflate away the value of the medium that the debt is denominated in. In other words, if you've promised somebody $100,000, you inflate away the purchasing power of that $100,000 down to $20,000 or $30,000 and make that debt more manageable. I know you want a simple declarative statement. Sadly, my name isn't Janet Yellen, and I can't manufacture one for you. I would also point out, however, to your listeners, and I think this is important, that the way we have defined inflation has been fed to us top down by the Fed. And maybe it isn't fraud, but it's misleading. An example would be the Consumer Price Index, the CPI. First of all, it's been adjusted for so-called hedonistic reasons, which is to say, it isn't a quantitative measure, but rather a narrative measure, like everything else that's political. The second thing, and this is astonishing to me, is that the Fed's estimate of the cost of living doesn't include tax. While government expenditures are over 40% of GDP,
Yeah,
the idea that your cost of living doesn't include tax,
crazy.
I suspect, Daniela, that would be okay with you if you didn't have to pay the tax. But given that you do, a calculation of cost of living that doesn't include tax seems very odd to me. I understand that government probably shouldn't be considered to be a consumer good. Unfortunately, it's a good which you are forced to consume and fund. And people, when they are thinking about the impact of their savings and their earned income relative to their purchasing power, need to think about inflation very differently than a slavish reliance on the CPI.
Oh, that is so well said. And I'm happy you brought up the point about tax, Rick, a real good one. So, it seems like we're living in this world of, fake earnings, fake GDP, fake interest rates, and super high valuations. The Fed's in a corner.
I think the Fed is in a corner. I think they're there by popular demand. When I see what the Fed does, it reminds me of an old Pogo cartoon from my youth, where Pogo is in the swamp, and he says, "I have met the enemy, and he is us." The politicians and the Fed aren't doing anything that we aren't asking them to do. Nobody wants to live within their means. For everybody, somebody else's necessary program is our definition of fraud and waste. So, we have met the enemy. The enemy is us. And I suspect it continues until it doesn't.
Until it doesn't, what does that look like, Rick?
I don't know. I really don't know. I know, again, as a journalist, you want a simple declarative answer. At 68 years of age, I'm fresh out of those. What it looks like to me is that you can't, however convenient it might be, rely on society to live your life for you. And so you have to save because society won't do it for you. You need to do it for yourself. You need to invest. You need to forestall consumption so that you're able to consume in the future, because the idea that society will be able to provide for you in the same way that you have come to expect is very imprudent planning.
Save, invest, and what you're describing to me when you speak like this, I think of this is the momentum behind cryptocurrencies, of an abandonment towards the current system and the desire and will to build a new type of monetary system. Do you not see that momentum carrying forward into the future?
I hope I do see that momentum carrying forward to the future. I think that your listeners need to be very careful about the cryptocurrency or currencies
Let's talk
that
about
they use as an investment medium.
Okay.
Remember that ideally a currency is at once a medium of exchange and a store of value. What I like about the cryptocurrencies is that I get the part that its value stems from the size of the network, very much like one telephone had no value, but 1 billion telephones have very high value. The fact that a broader community adopts a cryptocurrency, and it becomes a medium of exchange, delivers some value in and of itself. But I think one of the things that's happened with the rapid adoption of cryptocurrencies is that rather than being currencies, they've become trading sardines. And I think the very volatility that you see in some of the cryptocurrencies, while it increases their speculative appeal, ironically causes them to lose their utilities as medium of exchange. As an example, if a cryptocurrency exhibits 10% upside in a week, that's great for the speculator who bought it on Monday. But somebody who used it to buy a bag of groceries wouldn't know how much they paid for the groceries, and the grocer wouldn't know how much he or she received from the groceries. So it's ironic that the appeal of the cryptocurrency, which is to say the volatility, diminishes the utility of the currency itself for its so-called designed purpose.
So brand matters for you when it comes to the cryptos. Rick, you said not all of them should be used for, wealth preservation or whatnot. Which one? Like, I mean, so do you just stick to, or like, ones like Bitcoin, Ethereum, what falls in that spectrum for you?
Well, at present for me, because I'm a 68-year-old Luddite with limited technological skills, I'm out of all of them. They all gave me more price appreciation than I deserved. When the price of something that you understand or don't understand, pardon me, goes up, and it goes up for reasons that you don't understand, I don't think that you're richer. You're simply more involved, which is to say, if you don't turn it into cash, what you have is a bigger undescribed asset. So for me, I'm out of it. I struggle. I suspect that in my future, there will be several cryptocurrencies. And I like that. I'm a consumer of currencies, Daniela.
Mhm.
I spend Canadian dollars, I spend euros, I spend US dollars. And the idea that there's a whole bunch of currencies, some of which are private, each of which are competing to offer me more utility, as a consumer seems to me like a very good thing. Because I like a medium of exchange that's similarly a store of value, I suspect that ultimately I'll have a reasonable amount of my savings in coins, if that's the right phrase, that are tied more directly to the price of gold, and in fact represent digital ownership, authenticated digital ownership of gold held on my behalf.
So crypto's backed by silver or gold, for example.
Correct. And there may be other asset classes where the existence of the asset and proof of title are represented on the distributed ledger or the blockchain. I could very much see the distributed ledger replace securities markets, as an example. I could see them replace ETFs with much lower transaction costs, and frankly, doing away with the need for the Depository Trust Corporation. All that's extremely exciting to me, extremely exciting to me. And I'll be watching that with interest. The idea that I'm going to consign my future to a medium of exchange that isn't a store of value, which is to say some sort of digital coin that replaces the Zambian kwacha or the US dollar or some other unsecured obligation of society's goodwill, is of much less interest to me.
Let's use the example of Doge, because it won't be the first and it won't be the last. I'm sure we'll see other episodes like it. I've had friends calling me saying, look, I made a substantial amount of money off of Doge. I had one friend saying she paid off her mortgage in Doge. And I guess the takeaway is, what do you make of opportunities like that where you could get in, get out, and make a fair share of money? What do you say to someone who's contemplating those type of coins or plays?
I'm an investor and I'm a speculator. I'm not a trader. The idea that I buy something that has no intrinsic value because I think the narrative around no intrinsic value trades higher is interesting to me, but it's of no value. One, I think, good aspect of myself as an investor and a speculator is I am completely immune at my age to fear of missing out.
Nice.
I've missed out on a lot of things, and I've made a lot of things, and neither are of particular interest. I don't know if you remember this, Daniela, but I remember it well. 7 or 8 years ago, you and I had an interview, and I talked about two types of speculative error: the error of omission and the error of commission. The error of omission is where you missed some hot penny stock that was worth nothing but traded from 25 cents to a buck. And you missed out on the move from 25 cents to a buck because you were rational enough to understand that when it was selling for 25 cents, it wasn't worth anything. That's an error of omission. An error of commission is where you buy that stock at 25 cents and it goes to its intrinsic value, which is zero. Missing out is less of a sin than losing money. And so I would point out to people that are afraid of not trading a useless asset because it might go up, and ask them how they would feel if that asset traded to its intrinsic value. One of the things that I want to get across in interviews like this, Daniela, the reason that I'm disgracing myself so thoroughly in my declining years, is I want to point out to younger speculators that the correct way to build your wealth is to understand the delta between the price of something and some approximation of its value. There are other ways to make money, but the surest way to make money is to understand an asset that is undervalued in a probabilistic sense, and buy that asset. Think about why you bought it and think about what might cause you to sell it. There are all sorts of sexier theorems. And don't get me wrong, even at age 68, I'm not putting down sex, but there's a time and place for everything. And I would prefer that people didn't confuse excitement with investment and speculation.
I'm so happy you said that, Rick, and it makes a lot of sense, and hope a lot of people are listening to your words here. That fear of missing out is not a sin, but I guess human nature is you just want a piece of everything, and you don't want to miss out. And you hear all these stories, but we all know that we don't hear the other half of the story of people who have lost tremendous amounts of money.
But Daniela, you're a great broadcaster. You might know somebody who made a boatload of money as a banker. You would be passionately unhappy as a banker. So continuing as a broadcaster, despite the fact that somebody else is going to make $1 billion as a banker, is the same as fear of missing out. It's insane.
It's insane. Yeah, no, it makes a lot of sense. And that's why I'm so happy you said that. I think it's important words for the current environment we're living in, because like I said, I'm sure that we're going to be seeing a lot of other situations like Doge. And I've always said it's quite simplistic, but it really comes down to understanding what you're investing in. It's simple, but just know why you're investing, and don't invest because your neighbor's buying it or because Rick Rule said so. Understand it and own it. And I think that's, I'm not here to give advice, but it really is that simple. Rick, you mentioned at the start, cash, precious metals. This has been your legacy. It continues to be. We have the miners outperforming physical gold as we speak today. Is that the better play?
The miners are, I think the answer has to be nuanced, Daniela. The junior miners are, as a group, from my point of view, way ahead of themselves. I think if you look at them as a group, they've become a very dangerous asset class. Interviews that you and I did in 2017, when nobody cared about them, I described them as pathetically cheap. And now I describe them as Doge. That isn't to say that there aren't points of value within the juniors, but I've never seen a bull market that has gone from the best of the best, which is to say the Francos and the Wheatons of the world, all the way down to the Flotsam and the Jetsam and the Dross, the penny dreadfuls. Now, as you have known, the junior sector has been astonishingly good to me, but it's important that your listeners understand the next thing I have to say. If you merge every junior mining company in the world into one company, let's call it Junior Explorco. In other words, if those 2,000 companies went to company heaven and there was only one company left, that company in a very good year would lose $2 billion. In a bad year, it would lose $8 billion. How much money, Daniela, would you pay to lose $2 billion a year? Which is to say, the sector as a whole is valueless. That takes away from the fact that 5% of the companies in that universe generate such extraordinary returns that they add legitimacy and sometimes even luster to the space. So I would suggest to you that if you are going to speculate in what I laughingly call the penny dreadfuls, which I love, that you work hard at it, that you limit the number of speculations to the number of hours per month that you are willing to spend on your portfolio. Because if you buy the sector from the point of view of momentum and fear of missing out, you will likely lose half your money. I think too, however, that the middle market in resources, particularly those resources that continue out of favor,
Right.
exhibits fantastic value. The mid-tier gold producers,
Right.
as an example, are trading at the best relationship between EBIT to enterprise value at current gold prices, using the forward strip as a predictive mechanism, that I have ever seen. I've never seen them this cheap. Similarly, the mid-tier Canadian oils, despite the fact that Greta, as an example, doesn't like oil, represent on a net present value to enterprise value basis some of the best opportunities that have ever been exhibited in the space. Looking a little farther afield, farmland in the upper Midwest in the United States with the increase in grain prices, that hasn't been reflected in farmland rents or farmland prices yet. So there are incredible opportunities that I see in the natural resource business. They just aren't the opportunities that are moving yet. So they aren't the opportunities that attract too many speculators yet.
So what I'm hearing from you, and tell me if I'm summing this up right, Rick, in the juniors, a few good apples amongst a basket of really bad apples. And in the mid-tier, we have more bushels of better apples.
Correct. And even the bad apples among the juniors have gone up by 200%. So people are desperate to play them. I mean, truly, I think that the juniors, particularly the private placement part of the juniors, where you don't get a warrant, is a minefield. I think it's extremely dangerous. And I think that people who aren't willing to do the work should avoid the sector now.
What would a Newmont-Barrick merger mean for the industry as a whole?
It would be spectacular, depending on the nature of constructing the merger. A well-constructed merger does three spectacular things. It reduces general and administrative expense relative to assets under administration, and it can do it permanently. I suspect a Newmont-Barrick merger could take $300 million a year, maybe more, out of the cost structure. That's the same as one brand new world-class mine, except for that mine doesn't deplete. And if you're getting paid 14 or 15 times EBIT, that $300 million in cost savings adds $4 or $5 billion in market cap. It lowers the cost of capital substantially. The second thing it does is, by its very size, it increases liquidity, which by itself raises share prices and lowers the cost of capital. Finally, it broadens the reinvestment options open to the management and directors, so that they have a better chance to optimize the reinvestment of that part of cash flow that they choose not to distribute to shareholders. A merger of Barrick and Newmont would be, I think, a gold sector dream come true.
Wow. All right. Good thoughts, Rick, there. We talked to juniors, talked to mid-tiers. Is a better play or safer bet the royalty, the streamers?
I think it depends on who the investor is. For a passive investor, I think the answer to that is yes. The royalty and streaming sector sells at a premium to the rest of the industry, but it deserves to, because it's a better business. If you look at Franco and Wheaton and Royal, they're operating on 80% margins, whereas the producing industry is operating at 16 to 20% margins. So one would pay more for a business that was 4 times as profitable. To the extent that some of your listeners are actually willing to do the work to understand what they invest and speculate in, then they can afford to take more chances.
I want to get your thoughts on the run-up we've been seeing in palladium, platinum. What do you make of the story here? And are they the ones to watch in the precious metals camp right now?
I was afraid you'd get to that, Daniela. You're a good interviewer. I was a little early on palladium and platinum, which is to say 8 years early. So I feel vindicated now. I think that they're still interesting speculative vehicles, because what they're used for, probably investment vehicles too, what they're used for really is reducing airborne emission from internal combustion engines. Despite the world's fondness for electric cars, we're going to have internal combustion engines getting us around for 30 or 35 years. And what platinum and palladium do is that they reduce emissions from internal combustion engines. You don't see a lot of young kids walking around with picket signs saying more smog, more smog, more smog. The truth is that we want air quality, and a fairly small amount of platinum and palladium generates the air quality that we want in a car that sells for $60,000 or $70,000. Costs $150 worth of palladium to keep that car's emission standards perfect. What matters is that if you doubled the price of palladium, it wouldn't change the finished price of the car. So there's lots of room in palladium. Secondly, on the supply side, platinum and palladium are produced in South Africa, Zimbabwe, and Russia. I'm not saying that things are necessarily going to go wrong there, but those are three countries that have the ability to deliver negative surprises. And if you had a negative surprise on the supply side, the auto industry has to pay whatever it costs to reduce emissions.
I can't have Rick Rule, formerly of Sprott, on without bringing up silver and the silver squeeze. PSLV has become the vehicle of choice and praised amongst many silver investors. And I know that, I understand the situation you find yourself in. Perhaps you don't want to, I'll leave you the microphone to discuss, but, just your thoughts surrounding the silver squeeze momentum here, Rick.
Well, the delightful part of retiring from Sprott is I can now talk about Sprott with a straight face. It was odd that when I knew more, I could say less. PSLV was a product designed by Eric Sprott for his own silver supply, for his own inventory. And Eric wanted to design something that was convenient, something where he didn't have to trust anybody. He wanted no counterparty risk. He wanted no exchange risk. He wanted no storage risk. He wanted something that wasn't offered by the ETF. He created a product that at its time only served a need for himself because there was much more trust in society. There is much less trust in society now. And the consequence of that is that the Sprott physical products serve a need in society that's come to be recognized by society. I think it's a wonderful product, one whose time has come. At a period of time where the premiums on physical silver products, retail quantities of physical silver products can be 30% of the silver price, the idea that you can buy a proxy for physical silver at spot with the click of a mouse is attractive. At the same time, you don't have to buy it through an ETF. The Sprott Physical Trust does not accept deposit receipts. It does not accept delivery receipts. It only accepts physical silver. So you don't have to worry about part of your portfolio being an unsecured obligation of Deutsche Bank or JP Morgan Chase. So this is a product that's time has come, frankly. And it's lovely to be able to say that with a straight face, knowing that I'm no longer part of Sprott and I'm not constrained by the regulatory climate.
Right. Outside of the PSLV, there's been a lot of chatter about, whether there's silver really backing certain products. People I've spoken to in the industry say, look, the onus falls on the bullion dealer or, ETFs that perhaps weren't upfront with clients, but the fault also lies perhaps with clients who maybe didn't read terms and conditions or fine print. Where does the truth lie for Rick Rule?
Both places. You absolutely have an obligation to understand the contract that you sign, particularly when you buy unallocated silver. I have a memory of the 1970s when people who didn't trust the system began to buy quantities of precious metals from people who they didn't know and for some reason trusted. In many cases in the 70s, that silver and gold went to silver and gold heaven, which is to say that the unwitting investors trusted people who didn't deserve that trust. So I absolutely believe that, first of all, to the extent that you buy, you should buy from a trusted dealer. If you are buying unallocated material, you should know something about the balance sheet of the fiduciary. You should know something about the balance sheet of the company whose obligation you are actually buying. You aren't buying physical silver. You are buying a balance sheet obligation of the company that is selling you that delivery receipt. And if you don't know the balance sheet and the income statement of the broker or the fiduciary, you don't know whether you own that silver or not. And it's not their fault, it's your fault.
Very well said, Rick. I guess my final thought from the great Rick Rule is something that comes to mind. Our last interview, we've done plenty, but the last one really resonated with me was the first time you were on stansberryinvestor.com with me. And I got so many emails from people that you really touched something there. When I asked you, what was the game changer? Obviously everyone knows you're extremely successful. You able to take an early retirement. So you've done extremely well in your career. Kudos to you. What people remember for that interview is you said that you started recognizing or making a lot of money. The game changer for you was thanks to Bonnie, your wonderful wife, when she said, stop focusing on trying to make money for yourself, but help others. That really resonated with people. So I just wanted to thank you for those words. And I'm asking you if there's any other words of wisdom you can share with us during the environment we currently find ourselves in, Rick.
Yeah, actually, yes. Not all wealth is material. What I'm doing today, which is to say educating people. I mean, let's face it, look at me. If I went without food for a while, it'd probably be good for me. But, what I'm doing now, which includes things like mentoring finance students in Africa, it probably increases my reputation in the community. And I think that reputation is wealth, but it enhances my sense of well-being and it enhances my interest. Now I'm in the fortunate position where I have to worry less about material wealth. So other forms of wealth are more important to me, but I would suspect that people of all ages need to understand that the essence of wealth is enhancing your sense of well-being. And that isn't all material. To be sure, you need to look at the material things so that you don't become a burden on your family or on society, so that you can look after yourself. And if you're lucky enough, look after your tribe, however you describe them. But I think that there are non-material aspects of wealth that go around your sense of well-being, your place in your community, your reputation, your sense of self-worth, what it is that you can and have to give, that I probably should have paid a lot more attention to when I was younger. And mercifully, I'm able to pay attention to now, which really follows on probably the discussion that you and I had several months ago, where I talked about how I started making money when I stopped worrying about making money.
I love that. And I also makes me just think of, obviously we're consumed by social media and, the desire to look a certain part and wear certain brands. You've never been that person. How do you not get sucked in? And I mean that as a compliment. How do you not get sucked into that?
Well, Daniela, just so you know, Kirkland is a brand. It's just a brand that suits me.
I mean, you didn't need a Hermes tie to be.
No. I guess I was lucky. I was lucky with regards to that. I've never had a good aesthetic sense. Bonnie does aesthetics for me, so I could never compete in that regard anyway. And the idea that a pair of ill-fitting $1,200 shoes was better for me than a pair of $30 shoes that fit well just has always been beyond my ability to comprehend. I just, maybe I'm a freak. I don't get it. My sense of self-worth involves other things. When I was a younger man, people, they might have said, well, you might be more successful with young women if you do this, that, or the other thing. And I guess if the young women were interested in that, that's okay. But that meant that they weren't interested in me. And I, to be honest with you, felt that to be fairly insulting. So I, was maybe less interested in being respected for things that I didn't respect myself than I was interested in respecting others and respecting myself for things that did interest me, that held value for me. I'm very lucky in that regard, frankly, I think, Daniela.
So important. Truths coming from the great Rick Rule today. We are so lucky.
If I might have one more word, Daniela,
absolutely.
And you can edit this out if you think it's improper, but one of the things that I like to use these interviews for is spreading education, also having conversations with listeners. To stimulate this, I like to talk about things that the listeners are interested, which is always their own wealth and their portfolio. Further to that, if your listeners go to a website, sprottusa.com/rankings, and enter their natural resource stocks at that site. I will personally rank each portfolio 1 to 10, 1 being worst. And I'll comment on individual issues where I think my comments might have value. So if you think it's appropriate and you think that that would benefit your listeners, particularly those who have the low-priced, what I laughingly call penny dreadful resource stocks, I think this is a very, very, very opportune time to look at those stocks individually. And I'm prepared to help people do that.
Wow, that's incredible. Thank you. No, I'm happy you shared that. I think that's a wonderful tool that you're giving people access to who might not otherwise have, someone they could turn to, someone they can ask, when they go home at night, should I be in this stock or not? So thank you for that, Rick. I appreciate it. Come back anytime to stansberryinvestor.com. You're always welcome.
I look forward, Danielle. I want to thank you for taking the time to prepare for an interview. Sometimes being interviewed, your whole job is making the interviewer not seem quite as stupid as he or she is. And it's always a joy with you just to be able to have a useful conversation.
I appreciate that. I've been doing this way too long, I think, Rick, but I love it. I love what I do. I'm one of the lucky ones. Thank you, Rick.
You are.